All right, let's dive into the latest earnings from healthcare giant UnitedHealth Group. Now, this one is a real head-scratcher. We're going to try and figure out how a company can pull in more money than ever before, but at the same time see its profits get sliced in half. It's quite a story.
So yeah, that's the big mystery we're going to unravel here. It's this strange paradox at the heart of their latest report, and we're going to get to the bottom of it together over the next few minutes.
Okay, so on one side of the coin, you've got this incredible growth. The company's total revenues for the third quarter shot up by an impressive 12% from last year. We're talking over $113 billion, just a huge number.
But then, you look at this, the other side of the coin. Their earnings from operations got cut in half, a staggering 50% drop compared to this time last year. So, what on earth is going on?
So first things first, let's look at the good stuff. Where is all that money coming from? To figure that out, we've got to pop the hood and look at their main business segments.
And you can see right away their growth engine is just humming. Both of its big divisions, UnitedHealthcare and Optum, they both saw revenues climb. But it's the insurance side, UnitedHealthcare, that's really leading the charge, with a massive 16% jump.
So the big takeaway here is pretty clear. They're getting more customers. A lot more, especially in that key Medicare space. And on top of that, their pharmacy services division is it's booming. Okay, so if revenue is flying high, we have to ask again, where did all the profits go? Well, this brings us to the not-so-good news, and that's the ballooning cost of actually providing healthcare.
Now, to really get this, there's one key term you gotta know. It's called the medical care ratio, or MCR. The simplest way to think about it is this. For every dollar they get in premiums, how many cents do they have to spend on actual medical care for their members?
And here's the smoking gun. That MCR number jumped from about 85% to nearly 90% in just 1 year. That means for every dollar coming in, almost 90 cents is flying right back out the door to cover costs. That is a massive squeeze on their profits.
And the report points to kind of a triple threat causing this. You've got higher medical costs across the board, you've got less funding coming in from Medicare, and then you have changes to the prescription drug program. So long story short, it's just getting way more expensive to be in the healthcare business right now.
All right, now let's go a little deeper and see how this pressure is hitting the company's two different sides.
It really helps to think of UNH as two giant companies rolled into one. You've got UnitedHealthcare, that's the insurance business we all know, and then you have Optum, which is their fast-growing health services side. Think technology, pharmacy, and patient care.
And this table, wow. This really lays out the whole paradox perfectly. Look at that. Both businesses grew their revenues, but both saw their earnings fall off a cliff. And the insurance side took the biggest beating, a massive 57% drop in profits.
And if we zoom in on Optum for a second, you can see that its pharmacy division, Optum Rx, is the real behemoth. It brings in most of the money, and it's a huge part of the company's whole growth story.
But, and this is a huge but, even that awesome revenue growth couldn't save their profits. Just to give you an idea of how intense this pressure is, their Optum Health division saw its earnings absolutely crater, falling from over $2 billion to just $255 million. That right there, that is the squeeze in action.
So, you'd think with a tough quarter like that they'd be pretty pessimistic, right? Well, not exactly. The company's leadership is actually signaling a lot of confidence about what's coming next.
The CEO's message is all about the long game. They're basically saying, hey, we see the issues, but we're setting things up for strong, lasting growth down the road.
And it's not just talk either. They're backing it up by actually raising their earnings forecast for the rest of the year. And for the market, that is a really big positive signal.
So really, the whole thing boils down to this central tension. You've got UnitedHealth's powerful growth engine on one side, and this rising tide of healthcare costs on the other. And the billion-dollar question that leaves us with is, can that growth engine keep running fast enough to outpace the costs? We'll have to wait and see.